Welcome to today's session. I'm Marisela Gomez from the Lender and Training Partner Activities Branch. We will be discussing the important topic of confident credit underwriting. Today, we will provide a brief overview of key credit topics, including credit reviews, non-traditional credit, and credit exceptions. Also, we will engage you with some trivia questions that address frequently asked questions about credit. When evaluating credit for a USDA applicant, the process should generally align with standard credit reviews. However, if you find yourself encountering difficulties, it may indicate that you are overlooking a crucial aspect of the evaluation, and that is your underwriter. Your underwriter is an invaluable asset to your journey through USDA guidelines. Collaborating closely with them will enhance your understanding and navigation of these regulations. It's important to keep in mind that lenders may apply their own additional criteria or overlays, which can sometimes lead to confusion if they diverge from the USDA handbook. If you encounter any discrepancies or uncertainties, reaching out to your underwriter is essential, as they can clarify whether the issue stems from a lender overlay. Maintaining open communication with your underwriter is crucial for a smooth process. As an approved guaranteed lender, it is crucial to comprehend the regulations that govern our program and to ensure strict compliance. Nonetheless, it is vital to acknowledge that the ultimate decision-making authority resides with each individual lender. While adherence to USDA's regulatory guidelines is mandatory, lenders exercise their independent judgment based on their expertise and market insights, always prioritizing the best interest of their clients. For assistance in the credit review process, Attachment 10A, also known as the credit matrix, serves as a valuable resource. Attachment 10A is located in Chapter 10 of the Handbook 1-3555, which can be accessed on the link Training and Resource Library page under the Loan Origination tab. To find it, scroll down to the Documents and Resources section and select the 3555 Handbook for the handbook and the 3555 Regulation for the 7 CFR. If you have further questions after consulting with your underwriter, please contact our Scenario Desk team for support. Due to time constraints today, we cannot cover all the details in Chapter 10, so I encourage you to take the time to review the handbook and the additional resources we will provide at the conclusion of this event. Let's examine the process of validating credit scores. GUS will establish the acceptable credit score for underwriting recommendations, making it essential to review the GUS findings report. If the report indicates an accept or accept with full documentation recommendation, credit score validation is not necessary. However, you are still required to assess the applicant's creditworthiness, as automated underwriting systems may overlook certain details that a manual review could uncover. An accept status also means that applicants will be exempt from specific waivers and verifications, which will be discussed further in today's presentation. Loans that receive a refer or refer with caution recommendation, as well as those not supported by GUS, will require credit score validation, which will elaborate next on the next slide. If an applicant has only one eligible trade line on their credit report, verified non-traditional trade lines can be utilized to fulfill the cumulative trade line requirement. However, in cases where the credit report shows no score, it is imperative to adhere to the non-traditional trade line requirements. For loans categorized as GUS refer with caution, or loans not submitted or not supported by GUS, it is essential that at least one applicant whose income or assets are utilized for the loan origination possess a validated credit score. This applicant must have a minimum of 2 trade lines on their credit report, each having been open for at least 12 months based on the date the account was opened as indicated on the credit report. It is important to note that the validated credit score does not guarantee an acceptable credit history. It merely confirms that the applicant meets the minimum eligibility criteria for credit history. The underwriter is responsible for thoroughly analyzing the credit history. As I previously mentioned, if the applicant has only one trade line, verified non-traditional credit can be utilized to fulfill the required number of trade lines. Traditional trade lines that can help validate a credit score include those with a documented payment history, regardless of whether they are currently open, closed, or fully paid. As I mentioned, today's presentation will feature scenario questions that our policy team has received from lenders. We find it beneficial to incorporate these scenarios as they provide an excellent opportunity to demonstrate how regulations and handbook interpretations can be applied to practical situations. So our first question is, an applicant has two credit scores with the third credit score frozen. Does the third score need to be unfrozen? And the answer is yes. Applicants must ensure credit data frozen at any credit repository is made available. On a GUS refer, the applicant only has one credit score. However, the applicant has enough trade lines on their credit report to meet the credit score validation requirements. Are non-traditional trade lines also required? And the answer is no. Only one credit score is required as long as the credit score has been validated. On a GUS refer loan, there are two applicants on the loan, and the primary applicant has a credit score and meets the requirements for a validated credit score. The co-applicant does not meet the validation criteria. Can I proceed? And the answer is yes. At least one applicant must have a validated credit score. The other applicants are not held to specific trade line requirements. Now, our requirements have been met. However, your underwriter may require additional verification. An applicant has two auto loans reporting for 8 months and 4 months each. Can we use the aggregate of the two to meet the requirement of an account reporting for 12 months? The answer is no. You cannot use the aggregate of two accounts to report for 12 months. Each trade line must have been open for a full 12 months to be an eligible trade line for the purpose of validating a credit score. Let's review non-traditional credit. Applicants who lack a traditional credit history or a verified credit score can still prove their capacity to fulfill their obligations through alternative methods. A non-traditional credit history should not automatically lead to a loan denial. It is the lender's responsibility to determine if the loan complies with agency guidelines and represents an acceptable credit risk, regardless of the GUS recommendation. For those without a rental history, 3 trade lines are required, which may include a combination of traditional trade lines from the credit report with a 12-month history or eligible non-traditional trade lines. Applicants with a 12-month verification of rent or a VOR need to provide 2 trade lines, the VOR itself and one additional eligible trade line from the credit report with a 12-month history or an acceptable non-traditional trade line. It is essential that any non-traditional trade line has a 12-month history and has not been closed for more than 6 months prior to the loan application. Acceptable non-traditional credit sources, as outlined in Attachment 10A, include rent or housing payments, utility services such as gas, electricity, water, landline telephone service, or cable TV, provided these services are not included in the rent payments. A recent update has expanded the list to include monthly subscription services like Netflix, Hulu, and gym memberships as valid sources. Non-traditional credit can be documented in various ways, including the use of a non-traditional mortgage credit report. Self-reported trade lines may be included on a conventional credit report, and evidence from third-party verifications such as canceled checks, money order receipts, electronic payment records, payment histories from creditors or companies, and bank statements that clearly show debit payments for services or products can also serve as valid documentation. Let's examine additional scenarios and consider how the regulations and guidance outlined in this previous slides would be relevant to each situation. Can overdraft protection attached to a checking account be used as a non-traditional trade line? And the answer is no. Overdraft protection is not a credit obligation and is not used as an alternative trade line. If repayment on a 401k or is repayment on a 401k loan considered an acceptable non-traditional trade line? And the answer is no. 401k loans are considered personal funds, thus not an acceptable source for non-traditional trade lines. Can my borrower use verifications from two different addresses to combine 12-month rental history for non-traditional credit? And the answer is yes. As long as the combined 12-month rental history does not have any gaps, it can be used for non-traditional credit. This guidance is specific to rental history only, though. Let's proceed to discuss the implications of significant adverse credit. Taxpayers who failed to pay their federal taxes in full by the filing deadline are classified as delinquent by the IRS. It is important to note that obtaining an IRS-approved extension for filing does not extend the deadline for tax payments. Taxpayers must settle their estimated income tax by the original filing date to avoid delinquency. For applicants with a history of tax liabilities, making an estimated tax payment by the deadline is essential, although they can file their tax return later and still qualify for a guarantee loan if the payment is made. Applicants who have consistently received tax refunds may not be considered delinquent as they have not owed taxes in the past. However, those with outstanding federal debts are ineligible unless they can provide evidence of an IRS-approved repayment plan, which requires at least 3 timely payments made. It is also crucial to understand that lump sum prepayments do not satisfy this requirement. While applicants with multiple approved repayment plans may still qualify, the underwriter must assess their credit risk. Finally, applicants who have not filed their taxes and lack an extension are not eligible. A non-tax federal debt includes any financial obligation owed to the U.S. federal government that is unrelated to federal income taxes. Lenders typically identify these debts by reviewing the Credit Alert Verification Reporting System, also known as CAVERS, alongside credit reports and public records. It is crucial to verify the GUS findings report to ensure that the CAVERS verification result is marked as an A. If the results indicates anything other than an A, it is important to resolve the issue, obtain a new CAVERS data independently of GUS, and upload the revised results. Applicants with outstanding federal non-tax debts are considered ineligible until the debt is settled or a release of liability is obtained. Applicants who are currently behind on court-ordered child support payments are not eligible unless specific conditions are met. For payments subject to administrative offset, the applicants must have either brought their payments up to date, fully paid the debt, or obtained a documented release of liability. In cases where the child support payments are not subject to administrative offset, the applicant must have an approved repayment agreement with at least 3 timely payments made before loan closing, or have settled the debt in full prior to closing, or possess a documented release of liability. Administrative offset enables the government to withhold certain federal payments to recover overdue child support. And since delinquent child support is not classified as a federal debt, it does not appear in CAVERS. Therefore, a clean CAVERS report does not necessarily indicate the absence of an administrative offset. Each state operates its own child support enforcement office. When a state refers overdue child support cases to the Department of Treasury, it is essential that they also report this information to credit bureaus. Lenders may identify delinquent child support through credit reports and should perform due diligence to determine if the state has made an administrative offset referral to the Department of Treasury. To confirm whether the delinquent child support is eligible for administrative offset, you may need to obtain verification from the Child Support Enforcement Agency. It is crucial to document the loan file to ensure that an applicant with delinquent child support is not subject to administrative offset. This can be achieved by securing written verification from the Child Support Enforcement Agency, or if that is not feasible, by documenting any verbal communication regarding the matter. Let's examine various scenarios related to adverse credit. An applicant has a clear CAVERS result but has had a wage garnishment for over 3 years on a U.S. education loan. Is the applicant eligible since the CAVERS was clear? The answer is no. Even when the applicant's CAVERS is clear, if the credit indicates there is a delinquent federal non-tax debt, the applicant is ineligible unless the debt is paid in full or a release of liability is documented. The GUS findings report indicates that CAVERS has identified the applicant has a delinquent federal debt. However, we have documentation that this is no longer in the applicant's name. Is this documentation sufficient to proceed? The answer is an A CAVERS response is the only acceptable result for an applicant to be eligible. The applicant will need to contact the federal agency involved to clear it. A new CAVERS response of A will need to be obtained outside of GUS and uploaded to GUS as part of the complete loan application. GUS does not allow for additional CAVERS requests once a result is obtained. An applicant with delinquent state taxes is ineligible for a USDA loan until the debt is paid in full or they are released of liability. Is that true or false? The answer is false. Delinquent state taxes should be treated as an unpaid debt or collection. The approved lender should evaluate whether the debt poses a threat to the first mortgage lien and if it is likely to have an adverse impact on the applicant's repayment ability. We will now proceed to discuss credit exceptions. Credit exceptions are necessary for cases involving foreclosures, bankruptcies, deeds in lieu, and short sales that occurred within the last 36 months, as well as for instances of a 30-day late rent or mortgage payment within the past year, mainly for GUS refer with caution, and files not supported by GUS. It is essential to note that regardless of the GUS recommendation, the responsibility lies with the approved lenders to assess whether the loan adheres to agency guidelines and qualifies as an acceptable credit risk. These stipulations represent the minimum standards set by the agency, and lenders may impose additional overlays or stricter credit criteria. Credit exceptions are not necessary for situations such as overdrafts or for Chapter 11, 12, and 13 bankruptcies that have been discharged or completed for over 12 months, as well as for charge-offs and collections, among other examples mentioned in this presentation. However, it is crucial to note that it is the responsibility of the approved lenders to assess and ensure that the loan complies with agency guidelines and qualifies as an acceptable credit risk. Again, these guidelines represent the minimum standards set by the agency, and lenders may impose additional overlays or stricter credit criteria. Certain types of adverse credit cannot be waived by lenders, including delinquent non-tax federal debts, overdue child support, and ineligible results from CAVERS. If there has been a USDA loss within the past 7 years from the date of the loan submission, only USDA has the authority to waive this adverse credit. In such cases, you must conduct a thorough underwriting review, detailing and documenting the circumstances surrounding the loss. Along with the complete application, you must provide supporting documentation and a recommendation for loan approval, highlighting the positive aspects of the loan file that indicate potential for successful homeownership. USDA will then assess the provided explanation and documentation to make a final decision regarding the applicant's eligibility for a new guaranteed loan. Guaranteed loans provide a level of flexibility in credit assessments, making it essential to maintain open communication with your underwriter. We understand that applicants may face unique and temporary situations, and we trust our lending partners' skilled underwriting teams to consider credit exceptions when warranted. It is important to note that USDA does not make credit decisions. This responsibility lies with the lender's underwriter. When evaluating exceptions, underwriters must demonstrate that the issues were temporary, beyond the applicant's control, and unlikely to happen again. For instance, if an applicant has transitioned from a lower paying job to a new job with a better position, it would be concerning if they indicate that they have been with the same employer for 25 years. Therefore, ensure that the documentation in your file is coherent and substantiates your decision. Again, previous USDA losses, delinquent non-tax federal debts, overdue child support, and ineligible KVERS results do not qualify for lender approval credit exceptions. Let's take a look at some scenarios that may or may not require a credit exception. An applicant previously had a USDA foreclosure. Are they eligible for a new loan through USDA? The answer is maybe. Attachment 10A outlines the documentation that must be submitted as part of the fully underwritten loan file when a previous agency loss has occurred within 7 years prior to the submission to the agency. Rule development will review the information and determine the applicant's eligibility. There is no pre-approval process available, and the determination will be made after reviewing the complete application. Will rule development guarantee a loan where the applicant has less than 3 years from bankruptcy? The answer is maybe. A guarantee is possible depending on the GUS findings report and overall file documentation. If a GUS accept is obtained, no further documentation is required. If the results are a GUS refer, the requirements of Chapter 10 would apply, and a credit exception would need to be documented by the underwriter. Does a refer recommendation in GUS automatically require a credit exception? The answer is no. A credit exception is only required if the refer is due to a credit issue or if the GUS findings report require a credit exemption to be documented. This is why it's very important to thoroughly review the GUS findings report because it will tell you all the information you need. Let's examine credit considerations. Collections are factored into the credit scores, making credit waivers unnecessary. However, the underwriter must evaluate all collection accounts to determine the applicant's credit risk, regardless of the GUS recommendation. USDA does not require the payment of medical collection accounts. If non-medical collections exceed $2,000, one of the following actions is necessary. Either pay these accounts in full before closing, utilize an existing repayment agreement with creditor documentation, or include 5% of the total outstanding balance as a monthly liability without additional documentation. Please remember that all open collection accounts on the credit report should be recorded on the GUS assets and liabilities page, marked as omit with an explanation if the full payment is not required. Lenders may discover additional debts or increased payments on existing obligations after USDA has issued a conditional commitment, but prior to loan closing. These newly identified financial responsibilities, which were not included in the original loan application submitted to USDA, can range from installment loans and revolving credit accounts to property taxes and final homeowners insurance premiums. For instances where the total additional debt is $50 or less, you are permitted to retain the conditional commitment. It is essential that you keep all relevant documentation regarding the new or increased debts and payment in the permanent loan file with no further action required. However, it is important to recognize that these represent the agency's minimum standards and lenders may impose additional overlays or stricter credit criteria. When the cumulative debt amount reaches $51 or more, you are required to request the release of the loan in GUS. You must then input the new or increased debts along with their corresponding payment amounts, ensuring that all supporting documentation for these entries is retained. A new preliminary underwriting submission is necessary to verify the GUS underwriting recommendation, after which lenders must upload relevant documentation and complete a final underwriting submission to USDA. Only after these steps will USDA issue a new conditional commitment, which is essential for lenders to proceed with loan closings. When an applicant lives in a community property state, it is essential for the lender to understand and comply with state regulations regarding non-purchasing spouses. Since GUS can only access credit reports for the primary applicant, you must obtain the non-purchasing spouse credit report separately and manually input any debts as mandated by state law. This manual entry does not need a downgrade of the loan file. The purpose of obtaining the non-purchasing spouse credit report is solely to assess monthly debt liabilities, as their credit history cannot be used as basis for loan denial. If you opt to exclude the non-purchasing spouse debts in GUS, you must keep appropriate documentation in the permanent loan file to justify your decision. A recent update to note is that the requirement to upload the non-purchasing spouse credit report was eliminated from the handbook following updates published on August 5th. The likelihood of future mortgage payment success can be gauged by the applicant's current rent or housing payments. Lenders are advised to include these amounts on the income and expense section in the GUS application and/or the loan application itself. While verification of rental history is not mandatory for GUS asset files, it may be necessary for those categorized as refer with caution, or for files not supported by GUS. The findings from GUS will assist the underwriter in determining whether a 12-month verification is needed. It is important to note that if an applicant has made a rent or mortgage payment that was 30 days or more overdue within the past year, this is classified as significant derogatory credit and will require a credit exemption. All housing payments recorded in GUS must be properly verified and documented. However, applicants lacking a verifiable housing payment history are not automatically disqualified, as the final decision rests with the approved lender's underwriter. If housing payments cannot be verified, the rental payment should not be included in GUS. Let us take a moment to examine the resources available to you. Attachment 10A is located in Chapter 10 of Handbook 1 3555 and serves as a valuable resource for your underwriting review process. To access this chapter, simply scan the provided code. It is essential to consistently consult and carefully examine the GUS findings report, ensuring that all uploaded documentation aligns with your underwriting decisions. Be aware that any inaccuracies in data entries will require returning the file to the lender, which may result in delays in the review process. Your primary source for origination and servicing resources, as well as guides, is the USDA Link Training and Resource Library page. The Link homepage has recently been revamped to feature turn times for conditional commitments, enhancing both its design and functionality. This platform serves as an essential source of information, so it is advisable to bookmark it for convenient access, as you will likely find yourself visiting it frequently. Additionally, if you have overlooked any significant updates from GovDelivery, you can easily find an archive of past emails available on the site. If you haven't already, please remember to sign up for the GovDelivery notifications to stay informed. You can also scan the barcode to quickly bookmark the link library page. Our technical handbook, also known as Handbook 1 3555, serves to deepen the understanding of the regulation while providing additional insights. Comprising 19 detailed chapters, this handbook is intended to enhance the 7 CFR rather than replace it. For quick access to essential information, it is advisable to consult both the 7 CFR and the handbook. Remember to bookmark these resources and use Control F for efficient navigation. Our policy team has created a valuable resource in the form of an FAQ document. This document addresses insightful questions from lenders seeking a clear understanding of how regulations and handbook policies apply to specific circumstances. It includes excellent examples and some unique scenarios that illustrate these concepts effectively. We encourage you to take a moment to review this document. If you have further inquiries after examining your resource and tools, we are here to assist you. To obtain the contact details for the staff of the Single Family Housing Loan Program, please scan the provided code. You can also reach out to support by directing your questions to the appropriate email address for the guaranteed teams. This wraps up our training session. I want to extend my sincere thanks to each of you for taking the time to participate today. Your partnership is truly valued. Should you have any questions, please do not hesitate to reach out to us. I wish you all a pleasant rest of your day.